This gold long just set itself up so cleanly, going right into the weekend, creating really bearish sentiment with a long wick from a high time frame resistance level as well. And as you can see, it played out beautifully. I did, however, second guess myself. So entered on Friday just ahead of the close, right at EQ of the range. And then at the Sunday Open, I took off half of my position. And that was because one of the nuances that I look for, I wasn't familiar with exactly how it had formed. And so my confidence in the trade drops, and I wasn't comfortable risking the same quantity on the trade. But I'll walk through what this trade actually is real quick. First, we'll start off just looking at the 4-hour chart. That is the previous all-time high on gold. As you can see, it was relatively equal highs. So traders will see that as a resistance level. We had it sharp sell-off, been climbing back up quite steadily towards this high. So that supports the idea of us squeezing out any short sellers. Just the fact that it was very one-directional. Going into the close on Friday, we'd been consolidating below that level. And what really gave me the confidence was the fact that this really long wick forms. Now, how I look at wicks is I see them as being enticing for traders who see that as a bearish rejection. So when I see a long wick in a bullish market coming from a what would be seen as a resistance level, I assume that traders will be seeing that, thinking it's a bearish signature, and that it will continue rolling over lower. And I like to ideally phase that. There are ways to tell if that wick is more likely to be run over or not. And one of those concepts is if it's a last second wick, then it could be a real rejection. And what that looks like is just if the wick itself forms in the final portion of that candle. However, with this 4-hour candle, the wick forms at around 12, which is basically the mid part of the candle. So it's not a last second wick. It's just a 4-hour long wick that is enticing shorts. As it drops down into this range, you can see that we have a dealing range at this point. So we have the high up there down to the low all the way down there. And so you can find the midpoint. So that's equilibrium of that dealing range. I'll make that a different color. So at EQ, that's discount below, premium above. You can see that we actually end up consolidating and spending a lot of time at deep discounts below here. When we are consolidating at a discount, the only reason to be doing that is to be accumulating a new long position. So traders seeing a bearish rejection will be then trying to sell, chasing the short. And while they're selling, smart money can be accumulating a position. Or alternatively, we can be engineering liquidity above these highs for the purpose of accumulating that buy side and then selling off. Now, I had to distinguish what the difference was and which one of these was the case. And just kind of dropping down the time frames pretty fast, but yeah, I don't want to get too deep into the technicals that support it. I want to really stick to the narrative behind the trade, and then after I've explained the trade as a whole, which is essentially, if you remember, the long from here up to there, then I'll dive more into the technicals that supported this trade. But the main thing I want to point out at the moment is that we have this long 4-hour wick rejecting from a resistance level. We're in a bullish market. We're very likely to break out, make a new high. And we had made that high at 380s. So very likely that we run up at least to the 420s. And as you can see, we actually hit it right there before running higher. Now, I mentioned that there are two possibilities. We could just be consolidating down here to grab buy side and then sell off, or we can be accumulating down here to then continue pushing higher. Now that comes into the narrative. So the narrative is that traders are being enticed to sell, and we're consolidating down in this area. There are a lot of technicals in this area that show accumulation. But one of the things that stood out to me was the fact that we have this high. We also have this high here. So once again, having these sharp rejections and pushes lower from a resistance level, you'd see that, people would probably look at this and say, oh, yep, smooth highs, relative equal highs, strong resistance, and then it sells lower, further enticing shorts. So you can assume that traders are selling below this area. They were given an entire 13 hours to go short while we consolidated at a deep discount below EQ. When we then push higher, I can then assume that anyone who sold down here, they are now trapped short. Some will have stops up here, but more than likely, a lot of them will have their stops further in the range. There's a concept that I use called liquidity mid, and that's essentially you grab the most premium buy side pull in this particular scenario, and then you go and find the next swing point that has a buy side pull. The idea is essentially that if price was bearish, price would respect the midpoint. If we're bullish, it would get a closure past the midpoint. But in this particular time frame, you can see we actually didn't hit that midpoint of the range. And that's kind of where I started second guessing myself, because I actually to put on the trade after being on the 5-minute time frame, which is this time frame right here, and I saw that we had this swing high. You can get rid of this box. We have this swing high here, and then I went to find the next most obvious buy side pull, which is this beautiful impulse high. Impulse highs become a very strong drawn price and very likely to get hit. And as you can see on this 5-minute time frame, we clearly closed above the midpoint of this liquidity mid. And to me, that indicated that, okay, prices showed a willingness to get up to this high, and therefore I'm looking to buy on the pullback. That was the initial thesis, and that's why I bought here right on Friday. Those two lots, or two micro lots, risking, I had a limit buy down here, and all up it would have been $30 risk, and then I ended up reassessing where my stop loss was, moving my stop to here, and reducing my risk as well. So it's only risking like I think 10-15 bucks. But yeah, but I second guess myself because I haven't nuanced out what time frame I should be looking at when using this concept. There's a very powerful concept that I'm looking to implement more in trades. As far as my trading goes, I'm also beginning to see that the theme I should be focusing on is essentially squeezes. So long squeezes or short squeezes. Basically, when I can see a clear narrative of who is on what side of the market, and therefore I can trust that we'll get an extended move, and I can really read how price action should be moving in that scenario. And with my stop loss placement in this trade, this is a great example of how I can use that. Is the narrative of this trade is that it's going to be a short squeeze. We have enticed shorts from this high time frame resistance level. We then consolidated below this resistance level here, and therefore I'm assuming there are traders who are trapped short in this area, and their stop loss is up in this area. Therefore, if we get a pullback, I'm expecting us to continue rallying up towards this high. If we were to pull back very deep into the range, all the way to here, sure, it could happen, but it's unlikely because that would kind of negate the idea of traders being trapped short. Because if a trader is short and price comes back to their entry, they can just get out at break even, and that would, that would be against the logic of a short squeeze. So that's why I bought right at EQ, and had my stop sitting down in this area. Now I could have also, and yeah, my stop was in the area because if price came that deep, it would negate the idea of this being a short, sorry, if price were to come deep into this range, it would negate the idea of there being trapped traders down here. My stop loss is also using that exact same concepts below the midpoint between the most discounted sell side pull and external range of this particular dealing range. was actually precisely at EQ at the midpoint. But essentially, if price were to drop down, I'd need it to respect that area as well. So realistically, stop would be about there. But that kind of covers why the stop loss was there and how I'm able to use the narrative of a short squeeze and trapped traders to position my stop loss for the initial entry. Now, I did get multiple entries through this range, and you'll see on my executions, I did get shaken out a bit, or shook myself out, but I managed to get some other really nice entries here and there, using different signatures and entry techniques, but all within that same trade idea. And I'll go over that in a minute. But yeah, but to start with, I'll start off over here, and I'll jump over to the 1 minute time frame. But yeah, the important thing is that really long wick. And here's a very key point. This long wick is on a Thursday. We then close the week just below it. So going into this is a concept that I really love to employ, is when the high time frame paints a very clear, deceptive narrative going into a weekend. For example, if there's a very long wick and we're going into a weekend, I see that as them creating a bearish sentiment going into the weekends that traders will begin selling. And then as soon as the market opens, it can run higher as smart money has accumulated those orders. Better jump over to the 1 minute right here, and I'll talk through kind of more of this stuff. And I'm going to actually replay this chart as well. What on earth? Just to here. Just so that I can not be distracted by what is happening currently. So creating that bearish sentiment going into a Friday, especially like the fact that we actually sold off in the PM session and closed all the way down here. You'll see I've got these 3 dots down here, and this is actually something I drew up right at the time of my entry. What I recognized is that we had just had a market maker framework play out. Now the market maker model has the first stage, second stage, and then after that there'll be a reversal, or if there's no reversal, you'll get an impulse rejection failure, which is a second stage IRF, which is a concept I came up with to detect when we're going to get extended price runs. But in this particular scenario, we have first stage, which is the break below this low, and I'll mark that out as white. So reversal, retracement, we have the intermediate term high, and then once we break that low, this is first stage has now played out. We then retrace, have a partial entry into a gap, or just a shallow retracement, and then second stage, which is a more extended run low. So once we break this low right here, that becomes second stage has now played out. And once second stage is played out, we are looking for signatures of a potential reversal. Now we do get a 3 drive pattern, which is what I drew out. And that's why I was very interested in this as we hit it as well. We were hitting EQ, already mentioned that I didn't anticipate price should come down here. And I actually placed my stop loss also based on the idea of this being a 4-hour candle low. So this 10 a.m. candle, there's a possibility the price could reach down to just tap that. So I decided to make sure I gave it room to do that, plus a 5-minute candle taking me all the way to here. And that was kind of the level that I would have been fine with price coming down to. And this just gives a bit more room below that. But yeah, so we'd had first stage play out, second stage, and then a 3 drive. So that's not a reason to enter. It's simply a confluence that, okay, I can kind of see the picture playing out exactly how I'd anticipate. We've also got all these nice smooth highs above us and going into that close on Friday. So obviously to start with, a bit of a wider stop loss, anticipating a very large move. Like the minimum I was expecting it to reach to was this high, and that was going to be the minimum I'd expect it to reach to. We're knowing very well that we're very likely to hit this high. And once we hit this high, there's all-time highs right above that. You can see that's played out beautifully. However, As I mentioned, I did get shaken out in this area. Not really shaken out, but I'd made a decision to take off partial of the position, or take the position off and re-enter if we got a strong close through a certain threshold. And I'll talk about that right now. So if I grab out or if I just do this, midpoint of this range, which is precisely here. So that's now the midpoint of this dealing range. Shall do this color because it's a specific type. Midpoint of this range, the idea is that if we were bearish, this is an area where it would then be able to head back lower. I wasn't expecting that to happen. However, I was aware of it, and I've recently developed a technique for entering at EQ of the range, and that's what I call a event horizon confirmation. Essentially, that's what EHC, event horizon confirmation, what it means depends on the framework context. However, in the context of a squeeze such as this, which is actually a squeeze reversal as well, where this 4-hour candle doesn't take out the previous 4-hour candle low, measuring the midpoint of that range, which is here, and I'm looking for us to get above that midpoint and then get two, in this case, 5-minute candle closures above it, and then I'm expecting that that whatever displacement sent us above this should then hold, which in this case, it appears to kind of be this area here. The idea is essentially that once we displace and end up on the other side of this and hold above it, that gives the indication that the squeeze, the short squeeze, is now underway. So for us to return back to the start of that displacement where we displaced away from trapped traders would negate the idea of this being a short squeeze. However, it never came back to give me my entry, which would have been right at that midpoint. So you can see that I got out once I started rejecting from after hitting EQ, hitting this hourly high as well. Then I would have got back in, but it just didn't quite give it to me. And I missed this run up right here. Now I actually managed to get in a very nice entry right here, and I'll talk through why that was and how I was able to get repositioned and actually get a much tighter risk on this trade as well. Over the weekend, I had a look through trade ideas. I think it's in here somewhere. Anyway, somewhere you can find trade ideas on TradingView, and it's just people posting what they see the market doing. And there was an overwhelming amount of people who were looking to do this. A enormous amount of people. And I've been in this situation plenty of times myself where I've tried to sell on a pullback or buy on a pullback, and then prices just rips to my stop. And I recognize that this being a very likely situation for it to happen. What I really like about it is the fact that from this high down to the next liquidity pool, there's a really large gap. So anyone who's trying to sell either at this high or below it, if they are going to use a stop loss, and use a swing point for the stop, which basically everyone does, is going to be all the way up at the high. This is where this liquidity mid concept comes back into play, and as you can see, it is very closely related to the idea of a squeeze. If we were bearish, I'd expect the midpoint of the buy support. So let's say we're going to hit this buy support and then sell off. I'd expect us to not get past this midpoint. In fact, more likely you just tap it and then sell off. So the fact that we got easily above the midpoint shows very clear intention of reaching all the way up to this high. Lucky for me, it didn't actually hit the high, which gave me the opportunity to buy on the pullback. And I bought on the pullback with the assumption that traders were trapped. So traders who had been selling here and put their stop up at the high, they are now underwater. If the traders are underwater, anyone who went short here, and price made an aggressive move to where their stops would be, price is not going to come down and let them mitigate their position before hitting that buy side pull. That's why I trusted that price would not come into this lower area, and I was actually able to assume that we would not get back into this range. So I put a stop loss down here, really close, and I was able to buy right at the midpoint or just below it of this area, and catch a really nice run up and towards the highs. And I was simply targeting, as I mentioned, that 5-minute high. Jump back over here. So simply targeting this high right here. Got a nice pop up into that area, and you'll see that there are a whole bunch more longs going through this range, and that's because, as I mentioned, this was my draw, all-time highs above it, and then likely going up a lot higher than that as well. So I had a very clear bullish bias and bullish thesis, which allowed me to take longs, quite a few longs. I think just about all of them were winners, and all based on different ideas. I might as well talk through the other longs real quick and the ideas behind them. This one here, really nice. I really wanted to get more size on for this one, and I bought one with a market, and then I tried setting a limit just below it, and it just never gave it to me. But what I liked about this one is that excuse me. So impulse low, you drag that out. The idea with impulse lows and impulse highs is that when price hits them, that is a very likely place for us to reject from. There's a concept I have called a impulse rejection failure. And what that concept is if we have an impulse low and we reject from it, but then we get a closure back below, that indicates that that rejection failed and that we're actually going to sell off. Now, with every good model and every good framework, it can fail. And when it fails, it usually happens in spectacular fashion. And this is how half my models have come about, are actually from things that should happen that don't. And those are usually give you the ultimate trades. Like you probably know from your own trading that when your model doesn't work and you lose, price usually absolutely goes super strongly against you. I'm aware of that, and so when I recognize that, okay, this is an impulse rejection failure, this closure right here is bearish. There's another concept I have called a manipulation closure. It's actually a signature. Manipulation closure is when we get a closure of a candle that disrespects a PD array or any kind of level that it should be respecting, and then it instantly reverses back the other way. And that's what we have right here. We have a closure below a level that we shouldn't have closed below if we were bullish. We did not take out the low, and the very next candle instantly reversed straight back up. Also at 1959, going into the 2000 open. As soon as I saw that, I was like, yep, that looks really good. Jumping in long. Would have loved to get more size on, but yeah, checked on along and ran up towards the highs. And I actually targeted the most premium internal range high. So if I bring up the 5-minute chart over here, 15 actually, we got to see it a bit easier. So yeah, I targeted this high right here, and you can see that there. So that's the external range, which we did not hit. However, we are very likely to hit the most deep internal range liquidity pool and then get a retracement off of that. It happens all the time. And one of my profit taking rules on for trading is that when we hit a deep premium or deep discount internal range liquidity, I always take something off, and it was very highly probable we would hit that. So ran it up into the highs, didn't get the perfect fill because it was moving quite fast, but it's still quite a nice run higher. Now this next trade is recognizing that, so you can see I took another long up here and quickly took it off. I can't remember the exact, I know what the reason was. The reasoning on this would have been using the low time frame, once again using that liquidity mid concept, dragging out this 1 minute swing high down to probably a 15-second swing high, we would have got a closure above this. I would have bought and then expecting it to run and hit this high. It spikes and hits this buy side pull, which is what this concept indicates, that we're going to hit this buy side pull. But as soon as it did, it rejected back down, so I got out. Sells off. It runs out this impulse low, taps that, and gets a really nice reaction back out. Now at this point, it could go either way, but it was looking quite bullish. And as I mentioned, I'm very bullish, so I'm not looking for shorts for sure. And I wanted to get in long again. But how do I do it? Well, I use the same concepts, finding the midpoint between this buy side pull and this 1 minute swing high. Once we get a closure above that midpoint on this candle right here, we don't hit that high just yet. This closure indicated that we were planning to hit this high more than likely. So I bought on the pullback just below a swing low, and yeah, ran that up into the high and took one off as we hit the high. And then I obviously trailed the other one precisely to get tapped out at that same point. So put this one at break even, got stopped out, unfortunately. After getting stopped out, what was the... Oh, that's right. So I used the exact same concept as this, however, in this area. And this was kind of cool because we have the midpoint from this high up to the absolute high. And if you draw that across, you can see that we... Do we hit it? I'm not sure. Well, we did hit that high, but maybe we didn't hit it on... Hold up. Because I'll look at it on 8 cap as well as Black Bull. So I'd like to see if we actually hit that on here or not. But yeah, anyway, at the time I saw that we had closed above that midpoint, and assumed we hadn't actually hit the high. However, it looks like we did. But that still, nevertheless, gave me the confidence to enter that position long and trust that we should get a squeeze up into that buy side. So we did actually hit that high. But yeah, essentially closing off that midpoint, trusting that this should hold and getting that run high. And yeah, I left it from there. I was happy with that. But to summarize what this trade actually was, if I bring up, oh, this is a different chart, I see. So Black Bull, and I'll bring up the daily just so you get a complete picture of what it actually looks like. By the daily, you can see that we had a few long wicks already, so already creating that idea. A nice up closing day. We did leave equal lows down here. Another one of those reasons that I kind of second guess myself going into the weekend. I was still confident in the long idea, and there's no way I would have gone short. But as I mentioned, the fact that I couldn't tell if I should be looking at what time frame I should be anchoring this concept to, the liquidity mid, it kind of made me second guess. Because, for example, if I anchored it to the 4-hour time frame, which is over here, if I anchored it to this time frame, we're actually perfectly respected as the midpoint. And that's actually from that previous day, that high of day, to the previous day high, respecting that midpoint. And I thought, well, maybe it's actually respecting it. And at the same time, this is the previous week high, in fact. You can see that we actually ran above that and then rejected from that level going into the Friday. And that's another reason why I thought, well, I'm not actually sure if the only time frame that supports this particular concept of liquidity mid is the 5-minute time frame that we closed above. And then there are other signatures suggesting that maybe we could actually head lower, such as that Friday previous week high that we actually just rejected from. Also, the fact that we just hit ERL, and we could easily go from external down to internal in this area where we have, a few smooth lows. So I kind of saw that as well. And those are the reasons why I second guess myself. Now, the whole trade idea was not based on this concept. I didn't put it on the trade because of a liquidity mid concept, but it was just more a confluence. However, this concept is also what made me second guess myself the most, because the only time frame that supported it was that 5-minute time frame. That brings me to the more technical stuff as to why I saw this as accumulation. And I'll go through that right now. Now, I'll start off on the 1 hour. So on the 1 hour, initially, we have that sell-off, creates this nice long wick. So you know there's going to be liquidity below this long wick. We consolidate above it for a bunch of time and then take it out. Another reason why this is a low that was engineered for the purpose of accumulating is if we grab a fib, draw out the midpoint of that wick, you can see that we got a manipulation closure. And what that is a closure below the midpoint, which indicates bearishness. And then we run higher. Now, that is manipulation closure, but it also indicates that this is a original consolidation, which is a lot of the time used for the purpose of accumulating. So by dropping down below this area, we can assume that we're now accumulating below this sell side pull. At the same time, this also lines up nicely with this sell side pull over here, which once again is a very key low. And this is a concept called trailed old low, old high / old low. And the idea is that it's an obvious swing point that was clearly made for the purpose of accumulating, which we can see by the fact that we engineer this low. We then consolidate above it for a good 19 hours or so. We then have 3 drives below it before running higher. So it's a previous reference point. When you draw that out, a lot of the time price likes to come back and reference that exact same level. And that's what we see right here. Dropping to the next lower time frame. So the 15-minute charts. This is the 1800 open. So the new daily candle opens up. We do a little bull flag, consolidate above, and then sell off into the range. So really aggressive sell off, comes super deep in the range, and then rallies up towards this impulse high. What I really like about this is the fact that this really large down closing candle is a very enticing candle. People want to short that. We then climb back up towards this high. Now, as I mentioned over here with this 5-minute high, impulse highs make very strong draws in price. Anyone chasing the short, their stop loss is above the swing point. However, they are let off the hook. We don't reach it. We have another big range down closing candle that sells off. Both these ideas, these large range down closing candles, and create the idea of enticing shorts. We then spend a bunch of time consolidating at a deep discount. We then spend even more time, very high resistance, consolidating below this high before eventually popping up above it. Why that's important is that we gave plenty of time for anyone who's bearish chasing this move lower to then get short on this Friday. And that's how you identify an incredibly strong order block, is when the narrative fits the idea of there being trap traders. And that's what we have right here. So if we have traders who are trapped below this order block open, so that's the order block from the open down to the low. The midpoint of that order block is right here. That's what's called in ICT terms, the mean threshold. That becomes a very sensitive point in price from the open down to that midpoint. And I expected price should not get down to that area. I didn't actually trade in this area at all, but you can see how it played out and how that supported this trade up here. Is we have a previous old reference point. We then have a really obvious clean order block formation in the area. And after getting above this order block, we show very clear respect of this level with engineering lows, taking them out, rejecting above, hitting ERL, going ERL to IRL, coming down again and taking out swing lows, getting nice rejections back up, but all the time respecting this range and respecting the midpoint of the range, most importantly. eventually running up to this high right at 9:30 a.m. So very key time of day, the New York Equity Open, hitting that resistance level in quotation marks and getting an aggressive sell-off down from that level. So that aggressive run lower, see it better on the 5-minute time frame. That aggressive run lower is creating the idea of this being a resistance level, and people will see that, oh, we're rejecting from resistance, let me sell. If people are selling from this high all the way down to this low, that means that if we were to head higher, that would be a great opportunity for anyone who was long to buy. So there's a whole bunch of people selling. You can assume that they were accumulating in this area. They were buying as everyone else was selling. Then get that rally up, runs up in towards the highs, shows intent of reaching this high on the 5-minute time frame by closing above the midpoint of that range. And also just the way that it runs up towards it and gets really close. You also notice how we actually balanced in this entire inefficiency. From this swing low to this swing high, we've only got sell side delivery. Then we have buy side up through here. So this becomes what's referred to as a SIBI, a fair value gap. You can see that we actually perfectly filled that in. Now, when price perfectly fills in fair value gaps, and it's been a very sharp drop, what that's doing is it's balancing the range ahead of a run back into it, meaning that if we were to run back up through this range, we wouldn't have to retrace. And that's how you identify when there's going to be a very low resistance liquidity run, is when price balances the range beforehand, before actually running it out, it balances it. I'm not sure what other examples I could find, but yeah, essentially fair value gap, we balanced the range already. That means that when we head back up, it can just go in one direction. Otherwise it would have had to, like if we just trade up from here, it'd have to come up and then it'd have to come down and then it could go up like that. But because it's already balanced this range, it creates an environment where if prices wants to, it's able to run in one direction straight up through that level. So that kind of covers how this was very clear accumulation. We have a lot of lows being taken out, and we already saw the reaction from that level. We were clearly enticing people to short below this resistance level at a discount of the range. So this entire range, people were being encouraged to sell short in a discount. Then we got a clear intention of moving up towards this high, and then sold off going into the close on a Friday. So enticing shorts going into the weekend after Thursday, already rejected with a long 4-hour wick, creating a bearish sentiment from this high time frame all-time high resistance level. And that just set the stage for this beautiful run up the next day. And you can see the result of that. How I could have traded this a bit better. Well, I think, it's great to put on an initial position. I was kind of unsure. I wasn't specific with how I was going to put a stop loss in initially, because I thought, when looking at this, before I thought that I should be really basing my stop loss placement off of the narrative of there being traps traders in this area. Before I thought of that, I was actually looking at, well, we've got a swing low down here. It could actually kind of come down there. And if it comes down there, then it could even come down to this swing point. And if it came down to that swing point, then ERL is just below. And sometimes, price will come all the way down and then reverse. So it wasn't clear enough where I'm putting my stop. However, when I was able to recognize that, okay, the narrative of the trade, like the idea of there being traps traders in this area, that's integral to this entire squeeze narrative. So by price coming deep into this range, it actually negates this entire trade idea. And that allowed me to then redirect my stop loss to being more around this area, which, that's extremely good risk reward when targeting this Thursday high. So putting something on there is great. But as I mentioned, because I was second guessing myself, it was actually the right thing to do to take off 50%, because it meant that I was then comfortable with the position, taking that 50% off. And which, theoretically should allow me to trade a lot better. What happened over here, if I bring up the 5-minute chart, I'll be able to show kind of what that looks like, is that this midpoint of the range, so I'll move this so that we can see it on the 5-minute time frame. What I wanted to see for the squeeze is for us to get a clear displacement above this midpoint, close a second candle above that midpoint, and then I would have been happy to buy that with a stop loss at the start of whatever displaced away from the trap traders. But you can see we didn't really have any clear narrative like that. It's a very steady climb up towards that midpoint, and I didn't really have a way of determining where the displacement start was, or the impulse origin is what I technically call it. However, you could probably say that it was actually here. That's where the stop loss would have been. And that's simply because the only place that we created the idea of this being resistance and selling off from was from this high down to this low. And so from rallying from here to then getting that 2 times 5-minute candle closure above the midpoint, this is the origin point that rallied away from the trap traders to get back above that EQ level. I took this off assuming I'd be able to re-enter. I wasn't worried about the position at all, but I thought, well, I might as well take it off. Once it reconfirms up here, I'll be able to add back on and I'll put on even more size. And when that didn't happen, I just missed this move up here. But what's cool is how I was able to put on even more size with less risk, like much lower, really tight stop loss, and I could have put it on even more size, a lot more size, and it never comes back. But what I should be doing in future is identifying these areas where the narrative of the trade, like the structure that is integral to the narrative of the trade, where it gives me the ability to tighten my risk, and thereby really scale into position. So for example, an initial position, buying here, if it comes below here, then we're letting the trap traders off the hook, so stop loss goes here initially. Once we get this rally up through this range, we get to the point where, all right, we trap traders at the lows. If price were to come down to a certain point, that would now, like let's say down here, that would now negate that trade being a thing. And I could tighten the stop again. And potentially, if I can get a bit more familiar with how to use this concept I just mentioned, I could potentially say, okay, we should not come down to this point and get a tight entry. But then when I get something like this, this is my favorite part of it, because this was very clear and just the narrative fits so well that we have traders selling on the pullback with a stop above the high. I've done that plenty of times. I'm sure everyone has. And if you've done it, you know that it doesn't work too well when it does go against you. It never gives you a chance to get out. Now, I recognize that. I then recognize a very objective reason as to why I can trust it. So you'll notice that I changed my YouTube handle recently to Objective Capital. It's because objectivity is very, very key to my trading. And I feel like to be able to scale, you have to be super objective, super specific in what you're doing. So sure, I can say, oh yeah, well, it looks strong, let's go to this high, I'm just going to buy it. But if I'm objective about it and have very objective criteria, that will allow me to really scale and put on really big size. So the objectiveness in this particular scenario is the fact that we got a closure beyond the midpoint of this swing high and the next swing high. That is the objective thing that was confirmed. The narrative of this particular framework is that we have trapped traders down here. So what would negate this framework is if price then traded down and let those trapped traders off the hook, then it is no longer a thing. So that gives me a place that I can very objectively confirm an entry. I have a invalidation that's integral to the actual trade, which is if price came down to here. So if I was still in a position, this would be the place to really scale into the position. So if my initial entry was down here, I could potentially add more there. But when I get up to this area and I add even more, put a tight stop, if my bias is extremely strong, which in this case it was, especially with that high time frame sentiment going into the weekend with that long 4-hour wick, that would give me massive confidence to get in really, really strongly. And this gives me the perfect high probability area to do it. So very key place, a very key inflection point based on a high time frame narrative and sentiment driven narrative, where it gives me a really tight entry. And this moment right here, that is the place where you'd be able to scale in massively with extremely low risk. And let's say it just goes up to the Thursday high. So it just goes up to here. That's already almost 6R. However, because of the environment we're in, chances are it keeps on going. And that could have been a really awesome trade. Something I want to get better at is holding on to runners when the narrative makes sense and letting the markets tell me when it's ready to get it once it's done. Part of that is aligning my trades with the high time frame draw and the hourly trend, and that's what I'm trying to do more of, trying to aim for that high time frame expansion. As you can see here, I didn't do the best job of it. I ended up getting out of my whole position right there, and then just scalping a few longs on the way up. But yeah, the goal is to get to the point where if I have a trade on, I'm in the trade until the market tells me otherwise. And obviously, that's not always going to be the best way to do it, which is why I've developed the alpha and delta mode of execution, which is where alpha is in the direction of the high time frame draw and in the direction of the hourly trend, which this long is. And if I was trying to shorten any of this area, if I was, then it would be a delta, which would be basically a base hit profit taking protocol, because we are against either or the high time frame trend or draw on liquidity. And if something is an alpha condition, then I want to get to the point where I let it tell me once it's done. Obviously, I can target specific price targets, but then at the same time as doing that, I can also look to use trailing techniques, or just trust the weekly or hourly expansion to do its thing. But yeah, hopefully you found this insightful. There was a lot of free source in there and some pretty cool concepts that I'm beginning to lean more towards, especially the whole theme of squeezes, short squeezes, long squeezes. I'm beginning to see that could be a strong point for me, because when I can see that narrative, it gives me a lot of confidence, because I know what it's like to be on the wrong side of a trade. When I can see clearly who's on the wrong side of the trade, it gives me more confidence to hold, or that price should continue going in my direction. For example, in this area, a lot of people would have seen this saying, "Oh wow, we're so extended. It's super high. It's at all-time highs. It's got to retrace." But because I could tell who was offside, where the stops were, I trust the narrative that we should keep on pushing higher, which is exactly what happened. So yeah, that'll do for this video. Gold literally doesn't look like it's done anything in the meantime. If we bring that up, yeah, it's just been going sideways for a bunch of time. I don't know where price is going to go from here. I noticed that we actually failed to hit 500, so 4,500, fell just short of that. That is kind of a interesting thing, because if price were to continue higher, I'd expect us to probably tap that first. So yeah, we might have a bit of retracement during the London session, but at this point, yeah, I'm pretty neutral. My target was 420, which is precisely here, and that's partly why I've been like on this whole pullback. I was very confident in this being a long, all the way from back down here. Let's see if I can bring it up. I actually had a limit buy sitting below this weekly candle low. So this is a Monday. I had a limit buy sitting right there. Price just missed it. And I'm not saying I would have held out through all this, but you know, it would have been nice to at least catch the low, but it fell just a few points short of my entry. Well, less than a point actually. Because I had it literally sitting right there. But yeah, really the fact that we fell just short of the 420s, which for some reason whoever decided to program the market obviously thought it was a funny number, and price tends to reference that level a lot. The fact we fell short of it, I was pretty confident would head back up, and sure enough, it has this really nice climb. And I think one of the nuances that I've kind of observed in this price action, and I can relate to some lower time frame similar situations, is the fact that we had a very steady grind up towards this high. That is likely one of the hallmark signatures of a squeeze, is when we don't really let off the gas and we're just kind of grinding in a steady manner towards that high. And this could be a great kind of high time frame framework or environmental condition to anticipate when breakouts will work. So anyone who's a breakout artist and buys the break of the all-time high, they just made a whole bunch of money. Maybe a way to tell when this could be a good model to use is when there's a very clear squeeze narrative. So a really obvious high that was put on, a really obvious sell-off, and then a very steady grind back up. So not something that's just consolidating like that, but something more that is just steadily grinding against whoever's short. So anyone who's like, oh cool, I'm going to sell on the pullback with a stop off the high. Anyone who's doing something like this, their stop loss, sitting up here, and they're expecting, oh well, it came up to make a new high, and I'll add to my position here, and then it should at least get down to here, and I can make some money off of that. But then no, it just keeps on grinding high. When that's the case, you can imagine anyone who's ultra short getting, just hoping that, okay, well, surely it's just got to drop down at least a little bit, and I get out of break even. But then when that fails to happen, then that is when you get these beautiful squeezes up into the highs. So just an observation, something I could potentially implement a bit more. Another thing I'd love to implement more is just get more into using the sentiment created on the high time frame candles, such as this long wick and the Thursday wick, using that sentiment going into a weekend to form trade ideas on that Monday. That will do for this video. Catch you next time.